You obsess over negotiating a minor salary bump, ignoring the mathematical certainty that withholding a pathetic $200 a month from your consumption is costing you exactly $228.59 in pure, unearned capital. While you spend 40 minutes fighting over a $2 coffee or a 50-cent hourly raise, fortune is bleeding out of your checking account. This is Power Blueprint, and today you step out of economic illiteracy into cold, unyielding arithmetic. The poor believe investing is a linear savings account to buy things later. The rich know investing is the act of building a geometric machine that eventually prints your living expenses so you can stop renting out your time. You will master the math of the tipping point the exact year your money starts working harder than you do, and deploy an automated capital allocation that forces an 8% geometric return. Why do 95% of workers stay trapped on rung one of the ladder, selling their hours until they drop? Because they focus on wages instead of capital money, deployed to generate yield without physical labor. Put $200 in a shoe box under your bed for 30 years. And inflation, the steady rise in prices that destroys purchasing power, eats it alive, leaving you with $72,000 that buys $25,000 worth of goods. Where does that exact same money go to transform into $300,059? It goes into index funds, baskets of equities that let you own small ownership stakes in the 500 largest profitable companies on Earth. An index fund is an asset, an item you own that puts money into your pocket without demanding your daily sweat. When you buy an index fund, thousands of engineers, CEOs, and logistics directors work 12-hour days to generate your 8% annualized return, the historical average yearly yield of American industry. Are you ready to stop paying for their profits and start collecting them? Let us examine the mechanical steps of the ladder. You begin allocating $200 every single month on the first day of the month, without exception. This is your principal, the initial baseline cash you deposit out of your own paycheck. After 10 years, 120 payments, you have contributed $24,000 of hard labor cash. Your investment account reads $36,589. The difference, $12,589, is compound interest. Interest earned on previous interest, like a snowball gaining mass down a slope. Look at those numbers closely. After a decade of discipline, you earned barely $200 a year in interest. It feels agonizingly slow, doesn't it? This is the friction zone, the flat early stretch of the exponential curve, where 90% of amateurs panic and cash out to buy a newer used car. They want wealth on a Tuesday afternoon, so they destroy their own geometric engine before it turns over. When institutional investors acquired a $14 million industrial logistics park in 2012, the year one cash-on-cash return was a boring 4%. Cash-on-cash return is the annual net profit divided by the actual equity cash invested. When housing sentiment wavered in 2012, panic hit boardrooms, but institutions held because the contract math was sound. By year 10, contractual rent escalations and loan amortization drove equity values to $32 million. Your $200 a month S&P 500 index fund relies on the exact same institutional patience. The initial years are a test of emotional numbness, not high yields. Can you handle the silence of year 4 when nobody is cheering for your bank balance? Now look what happens when you cross into the second decade. At year 9, your total accumulated balance reaches roughly $30,000. At an 8% annual growth rate, that $30,000 generates $2,400 per year in unearned growth. Do you realize what just occurred? In year 9, your asset generates $2,400 annually, matching your exact out-of-pocket deposits of $200 per month. You now have a silent worker in your account, contributing an equal $200 every month alongside you. What happens when that worker never sleeps, never takes sick leave, and never asks for a raise? The growth accelerates. By year 16, total cash deposited out of your wages equals $38,400. At that exact threshold, cumulative interest hits $39,600. This is the tipping point. For the first time in your financial life, total interest growth, $39,600, violently overtakes your total out-of-pocket contributions, $38,400. Your money is officially working harder than your physical labor. Major university endowment funds operate on this exact math. Institutions like Harvard and Yale build multi-billion-dollar endowments, tax-exempt pools of invested capital, and never spend a single dollar of core principal. They fund operations entirely out of the excess yield generated past their tipping point. By automating $200 a month into an index fund, you are not saving money like a child with a piggy bank. You are constructing a micro-endowment. Now look at what happens when time reaches the final decade. By year 30, you have deposited a total of $72,000 out of your wages over your working life. The total account balance reaches $300,059. Examine that ratio. $72,000 came from your paycheck. The remaining $228,059 is pure, unearned compound interest. You did not work overtime for that $228,059. You did not negotiate with a boss for it. You did not sweat for it. You simply refused to interrupt the mathematical curve. Notice the parabolic acceleration. The final decade, years 20 to 30, generates $181,472 in growth, more wealth than the first 2 decades combined. How many workers liquidate their accounts right before the curve goes vertical? When estate lawyers structure multi-generational wealth trusts, they use this exact geometric explosion in the final decades to secure bloodlines. They lock capital away so impulsive heirs cannot break the exponential sequence. You are building a micro-trust for your future self, weaponizing time instead of relying on corporate salary favors. What breaks most retail investors isn't market crashes or recessions. It's the sheer, soul-crushing boredom of year 7. In year 7, you have auto-deposited cash month after month, and your balance looks unremarkable. Your coworkers buy leased sports cars, vacation on credit cards, and mock your humble index fund deposits. Will you break under peer pressure, or will you remain cold to public perception?
Patience is not a passive virtue. It is a calculated, predatory waiting game.
You must become completely numb to the boring early years, treating the first decade as a mechanical obligation rather than an emotional event. If you react to short-term market drops, you destroy your cost basis the original price paid for your fund shares. When prices drop 20% in a recession, amateur investors panic and sell, turning temporary market volatility into permanent losses. Wealthy investors treat market crashes as fire sales, accumulating higher share volumes at lower entry prices. Do you want to be the victim of economic cycles, or the owner who buys them on discount? Here is your exact assignment for today. Open a zero-fee brokerage account at Vanguard, Fidelity, or Schwab before 5 p.m. today. Set up an irrevocable, automated ACH transfer of $200 per month directly from your checking account into an S&P 500 index fund like VOO or F6. An ACH transfer, automated clearinghouse electronic bank transfer, removes human emotion from the transaction. Set your dividend settings to dividend reinvestment, DRIP, so every profit payout automatically buys more index shares. Do not open the brokerage application to check the balance for 90 days. I know the exact excuse you are making right now. You are telling yourself, I don't have $200 to spare right now. I need to pay off my car loan or wait until my next promotion. That excuse is a self-imposed prison sentence. If you cannot find $200 a month out of a standard wage, you have a spending control crisis, not an income crisis. You will find that $200 by cutting subscriptions, dining out, and worthless consumer clutter. Or you will remain trapped on rung 1 forever. Waiting for a raise to start investing is how employees reach age 60 with zero liquid assets. Capital doesn't care about your job title. It only cares about your calendar. Every year you delay starting your $200 allocation deletes tens of thousands of dollars from the final parabolic curve. Delaying 5 years costs you over $100,000 in end-state wealth. Can you afford to throw away $100,000 just to avoid 30 minutes of setup today? Stop begging for a salary bump. That pathetic $200 in your pocket was $228,059 all along. Buy the clock today or work for it forever. Subscribe to Power Blueprint right now. Execute your allocation assignment today, and I will train you on rung 3 in the next lesson.